less than 4%, which is unacceptable to me. In this episode, I'm going to address the question, what is the average return on money in the stock market? You're going to be shocked when I tell you the real answer and how you can do far better. Hi, my name's Doug Andrew, and I've been helping people earn better rates of return than the stock market now for more than 4.5 decades. Do you know that when I started in the financial services industry back in 1974, I had a Series 1 securities license? They don't even offer that anymore. That allowed me to sell any stock, bond, mutual fund out there. Now you have to have a Series 6, a Series 7, a Series 63, a Series 24, all of these to equal that one license that I had. From 1974 until 1980, I ended up being responsible for over 3,000 clients in 13 Western states. And we were trying our darndest to earn an average return of 12%. Now, actually, we were doing a pretty good job trying to time the market, but timing the market usually doesn't work. But I realized it was like playing red light, green light when I was a kid. There are some periods where when you play that game, for example, you take 20 steps forward, but then other times you take 10 steps back. And so you go back and forth. The stock market is like that. Sometimes you'll make 20%, sometimes you lose 10, 15, even 40%, like 2008. Well, it was E.F. Hutton, they were not an insurance company, they were a brokerage firm, that realized, why are we doing this? Why are we trying to earn 12% when people aren't netting 12% at the end of the day? In tax-deferred IRAs and 401ks, for example, if you're earning 12%, which most people aren't, the average person in the market is only earning between 6 to 9%, but actually they're buying and selling at the wrong time, and they're only earning 3.5%, as I'm going to share with you. But if you could earn 12, if on $1 million in an account, you were earning 12%, that's $120,000. Let's say you were pulling out what you're earning, $120,000. If that's an IRA or 401k, or it's a taxed as earned mutual fund, you have to pay tax on that. So in a 33% combined federal and state income tax bracket, you're going to have to pay $40,000 in tax. You're only netting $80,000 to buy gas and groceries. Now, a lot of asset managers charge 1% asset management fee on that $1 million. That's another 10 grand. If you subtract taxes and fees, you're only netting 7%. You're earning 12 and only netting 70,000. Hello? That's when E.F. Hutton came out and said, there's got to be a better way. And there is. They realized that the multi-trillion-dollar insurance industry are some of the best money managers in the world. And back then in 1980, they were earning on their general account portfolios made up of AAA and AA bonds and mortgages and so forth. They were earning between 11 and 15%. So they simply said, why don't we just have people earn 11 and net 10? Because those are tax-free and you have less volatility. Well, what's that 1%? It's not tax. It's the cost of the insurance that has to be in the contract in order for it to be qualified as a tax-free accumulation vehicle. But I would rather earn 11 more safely and net 10 than try to earn 12 and only net 7. I'd have to try to earn 16 to net 10 if I had my money in the market. And if you try to earn 16, you're putting your money in a lot of volatile investments in order to try to earn 16. So this is why people begin to ask, well, what is the actual average rate of return in the stock market? I'll tell you next. So when you look at the S&P 500, it's a good indicator. It's the top 500 corporations in America. That's usually a pretty good indicator of what the stock market is returning. The last 24 years, the S&P has actually only averaged just slightly less than 6%. Did you hear that? You don't hear that from the investment managers. They're always touting the gain years and so forth. But if you buy and hold, most people have only averaged 6%. Dalbar, who measures investor behavior, says that, during the best 20-year periods, You might earn as high as 9.14%, but you're not netting 9, you're only netting 6. But in actuality, if you bought and held the last 24 years, you would earn 6%. That means $1 million is earning 60,000. Now, you're only going to net maybe 40,000 after tax. Dalbar also says this. There's a difference between investment returns and investor returns. What are investors actually experiencing? Because retirees have their money in the market and their retirement income is dependent upon what the market does, they let emotions get involved. And so when the market starts to drop, like 2001 and 2, like 2008, like March of 2020 due to the coronavirus pandemic, and they see the market drop 20, 25, 30%, they go, enough already. I got to get out of there. So they sell low. And the institutional investors know this, and they are there to buy low. See, most people are doing the opposite of what they should be doing. They sell low, and they wait until the market rebounds really good, and then they buy back in high. That's when the institutional investors are selling high. Now, folks, Dalbar realizes the average retiree, therefore, is not earning 6 or 9. They're earning 3.49. This is what precipitated the 4% rule in the financial services industry. In a nutshell, what is the 4% rule? So the 4% rule came out because the financial services industry, when they realized that most retirees who have their money in yet to be taxed IRAs or 401ks in the market were only really averaging 3.5%. They did not want to be sued as a fiduciary for people outliving their money. So when they learned that the average person only earns 3.5%, they said to their advisors, don't you dare illustrate or let a retiree take out more than 4% a year because it will slowly deplete their nest egg, but not before their LE. LE means life expectancy. They don't want to be sued for you outliving your money. So they came up with the 4% rule. So that means they only want you to pull out 4%. If you take out more than that, they want you to sign a hold harmless, a waiver that you will not sue them for outliving your money. So that's pretty pathetic. It means that $1 million nest egg should only generate $40,000 a year of retirement income. Hello? You have to pay tax on that. In a 25% bracket, you're going to pay $10,000 of the $40,000 in tax. You're only netting $30,000. What about the 1% asset management fee? If you deducted that off of what you're earning, that's another $10,000 because it's 1% on the full $1 million. You're getting $40,000 and technically only netting $20,000. That's ridiculous. So if I could show you a way where you could earn 6% instead of 2%, how much better is 6 than 2? Don't say 4. It's 3 times as much money. It's $60,000 of tax-free income versus $20,000 of after-tax and fee income. But do you know that in my favorite vehicle, which I call the Laser Fund, I've actually averaged more like 8% payouts and even 10% payouts? How much better is $80,000 of income off of $1 million nest egg instead of a net of $20,000? Even before tax, $80,000 is twice as much, 100% more than $40,000. But remember, you have to pay tax on the $40,000. That's why the vehicles that I use for retirees are there to generate predictable income where you can get more like an 8% payout, even a 10% payout by using indexing and rebalancing. Meaning $1 million nest egg many times has generated $100,000 a year of tax-free income where they used to have their money sitting in the market and they were only taking out 4%, but they weren't netting 4%. This is huge. We have doubled and even tripled people's net spendable retirement income by having them reposition their money to be able to get it out of the stock market. I would recommend that no more than 30% of your money should be invested in the market when you retire. We've helped many people who are fed up with their money in the market because the stock market was really designed for you to try to grow money. It was never created to create predictable income. If you ask a stockbroker any advisor on Wall Street, when is the best time to liquidate or sell my mutual fund portfolio? And they will say, never. It was never designed to provide income or be liquidated. They want you to keep that money there forever. And so you need to do a strategic rollout. You need to get money out of the market, get it repositioned into something that's going to be more predictable and be able to earn you rates of return predictably, more safely than money in the market. That's why I like to use indexing. Indexing is a strategy. I get to participate when the market does well, but my money's not at risk in the market. My return is linked to what the market does, but when the market takes a nosedive, I can sleep at night because I don't lose a dime due to market volatility. Is this intriguing you? I wish I could explain more, but there's other episodes on this very channel that talk about indexing, which is a strategy. I'm not talking about index mutual funds. So look at these episodes, but I'm going to share with you how you can learn more by reading my most recent best-selling book, The Laser Fund. So in this book, you will see examples and charts of how I've been able to generate payouts of 6% conservatively, 8%, even 10%. That $1 million nest egg that maybe was repositioned out of IRAs and 401ks can generate $80,000 to $100,000 a year of tax-free income for as long as you live, if you live to be 120. And your money gets to participate when the economy and the market does well, but when it nosedives, when it crashes, you do not lose a dime. This is indexing, not an index mutual fund. Totally different. An index fund is a commodity. Indexing is a strategy. So if you want to learn more, this is my 11th book. It's been flying out of our warehouse. I will gift you a free copy of this book. How do you claim yours? Simply go to LaserFund, Laser fund.com, and you contribute a nominal amount towards the shipping and handling. I'll pay for the book and send it out to you. This is actually 2 books in one. This one is about 200 pages with all the charts and graphs and explanations if you like the detail. If you like to learn by stories, you flip it over and read this one. This has 12 chapters with 62 actual client stories and examples of how the Laser Fund is a superior dream solution for all kinds of financial goals, not just retirement, maybe college funding for your kids and grandkids, emergency funds, for real estate management, for business working capital. It's like a financial Swiss Army knife. And you'll understand why it's my favorite vehicle and why I would recommend that at least 40, maybe up to 60% of your retirement income not even show up on your 1040 tax return. The IRS will know you're receiving the money, but they're going to know it's totally tax-free because it's been grandfathered as a sacred tax-free cash cow for over a century. So read, learn, claim your free copy of the book now.